push. Da-dum. Hello, and thank you for watching this video on how I became a profitable trader. I am half a million, and let's go. I'm going to try to keep this pretty short. Try to stick to broad concepts, kind of the meta of trading, but really briefly, my equity curve or P&L used to look like this. Back in, I think it was April, I took a really big hit, and then I didn't make any money. Like, I was just losing until, let's see, May, June. I took a gig to help recoup my losses. July, I was trying to come back, and then what's after July? August. So August was the first. Nope, I was red in August too, but I was starting to get the hang of it. And then September of 2021 came along, and except for November, every month was green since September. So how did I do that? Okay. I am pretty good at understanding what a stock is going to do in any given moment. And what I used to try to do is I was looking for big picture plays, but I was looking for every big picture play. I wanted to get the breakout, and then I wanted to get the short, and then I wanted to get the push, and then I wanted to get the fail, and just all over the place really. And there was plenty of opportunity, and I was pretty good at calling the plays, but dividing my attention among all of these different plays never really allowed me to develop the confidence or the, more importantly, I guess, the conviction to really hold for the moves, And so what would happen is I would be on the right track, but so, buy a put here or get a short or whatever. So I would be on the right track, getting my entries in time, but then I wouldn't let it play out. Or if it came against me at all, I would get out, and I would take these losses just consistently. I like the way that Sanglucci put it. Sanglucci, if you haven't checked him out, you should. Sanglucci, he said, habitually losing money. Habitually losing money. And that's what I was doing, and it was not pleasant. All right, so I said I was going to keep this short, and hope you'll let me. This is what I changed. These are the things that I changed in order to gain consistency. So what's the first word in consistently profitable? Because that's the goal as a trader, right? It's to be consistently profitable. So first word is consistently. So in order to be consistently profitable, you have to be consistent. Consistent. Well, you can't control very much in the market, but the one thing that you can control is risk. Okay, so risk. That's the one thing you can control. And Huddy, I'm sure you've heard of Huddy, and Gritani. I'm sure you've heard of Gritani. I don't think he'll care if I misspell his name. They had a thing called Project 1K. Right, so how do I know all this? Like, I'm watching videos constantly. I'm studying constantly. And that's part of one of the most frustrating things when you're just not getting it and you're studying constantly. It's like, I'm putting in this work, so why am I not seeing results? Anyway, so I'm watching a Huddy and Gritani conversation or something, and they talk about Project 1K. So what is Project 1K? Well, Project 1K is where they decide that they're going to consistently risk 1K. So I feel like there's a lot of confusion about what this means because I don't know. I don't know what it is that people don't seem to get about this. But okay. So what it is you have the same dollar risk on every trade, right? Every trade. And they say things like A+ setup and stuff like that. Risk $1,000 on your A+ setups, right? But they also say not to take a trade that's not A+. They say to wait for your A+ setups, right? So, so what that means to me is that you're risking, you're only taking A+ setups, only A+ setups, right? And you're risking the same on every setup. Same dollar amount. Okay. So wait for your A+ setup and risk the same amount on every setup. All right. So they were doing 1K. I could not afford to lose 1K. So the first thing I did is I said, I'm going to risk the same amount on every trade. We'll go into that in a minute. Risk the same amount, dollar amount on every trade. Every trade. Okay, got it. And then secondly, only play A+ setups. Only play A+ setups. Well, all right. We'll get into this because this means different things too. But risk the same dollar amount on every trade. So I thought to myself, what is my account size? My account size equals X. How bad am I losing? I'm losing really bad. So I thought, okay, if I'm risking the same dollar amount on every trade and I lose every trade, I lose 0.10% of my account, then I can lose 1,000 times before my account hits 0. I can lose 1,000 times in a row. I don't want to lose 1,000 times in a row. And obviously, like if I was in that situation, my account's going to dwindle such that I wouldn't even be able to take position sizes big enough to risk 0.1% of where I started. But think about it. If you lose 0.1%, is it 1/10 that I'm working with? Yeah, 1/10 at that time. If you lose 0.1% on every trade, you can lose 1,000 times. So that's going to do a couple things, right? That's going to, it's going to give you comfort, right? Or so I can't tell you what it's going to do for you, but for me, it gave me comfort. It took away the fear of taking a position. I don't know what you would call that, fear of pulling the trigger, maybe. And it gave me, like, so these are emotional things, right, that it dealt with, but then it gave me a practical thing too, right, because it gave me time to figure my shit out. Sorry, stuff out. I guess now I have to do the thing for YouTube. It gave me time to figure it out. So, consistent R, risk. R equals risk. Or risk equals R, you know, commutative properties of equal signs or whatever. All right, so R equals risk, and risk equals, you know, 1/10 of a percent of my account at that time, which we don't need to talk about. It was a laughably small number. Like, it was ridiculous. All right. So now, another thing this does is it takes money out of the equation. In theory, out of the equation. Okay, so it takes money out of the equation. Yeah, the money is still there. You're still risking real money, like, but you don't have to think so much about how many dollars you're up or down, whatever. It doesn't matter, and here's why. Because of this. This is the truth. Process over profits. I know I'm all over the place. I'm sorry this isn't very organized. It's Saturday morning. I couldn't sleep. My girlfriend's going to wake up any minute, so I just got to get this out. But okay, process over profits. Look, anything that you make is a big old pile of poop, steaming, if you can't do that over time. So if you get lucky today and you have $100,000 gain, I mean, good for you. I'm happy for you. Like, you won the lottery. I'm not going to be sad about that. I'm not going to be mad about that. But when you think that that means you're a good trader, it's problematic. It's problematic because it's not repeatable. It's not sustainable. It doesn't keep you over time. And a lot of people who can do this once don't keep it, and that's problematic. I don't want that for anyone. All right, process over profits. So you've got your R, right? And what that means is, let's say the stock price is moving. Let's say you're going long, first of all, right? Stock price is moving, comes back down. You think it's going to break out, right? So this is your stop right here. Let's just say that's your stop. You think right now it's going to break out, right? So let's say this is $1. This is $1.10 at this other peak here, right? And it's at $1.05. $1.05. Okay. So you buy it, you know, you buy it and you're risking here. So the formula for this is going to be your dollar risk divided by your entry minus your exit is going to give you your position size. Okay. So we can take this and we can go 105 minus, so that's your entry. You get in right here at 105. Your stop is at $1 minus $1. It's going to give you 5 cents of risk, right? So let's say that your dollar risk is, let's just go really easy. Let's say it's 100, right? So 100 divided by 0.05 is going to equal 500, I think. I have a calculator by my desk because I'm constantly calculating entries and doing averages and stuff like that. Some people say you don't have to be good at math. That's true. You don't have to be good at it. See, I'm not good at it. That's actually 2,000. Let's see. 100 divided by 0.05 is 2,000. Is that right? Okay, so if you have 2,000 shares and you lose 5 cents, yep, so you're going to lose $100. Okay, so your position size is going to equal 500. Right. Now, a lot of people say, well, I just want to risk 10 cents. I just want to risk 40 cents. I just want to risk. The problem with that idea is it's not chart-based. This system, this formula, allows you to adjust to the chart. So let's say, okay, we've got risk is $100, right? So your R equals $100. Our formula is R divided by entry minus exit equals position size. Okay. So now let's say that this chart, right, is the one that we were just looking at. So this is $1, this is $1.10, and this is $1.05. And we can go actually on this chart, that's fine. Or I don't know, I haven't decided yet. Okay, so it comes up to $1, boom. And then it pulls back naturally, as it would. It holds support, or seems to, and now it's here, right? So right here at $1.05, we've got our formula: $100 risk divided by our entry at $1.05 minus $1. You need the parentheses because of the order of operations, but whatever, equals 2,000, right? So you're going to take 2,000 shares there. Okay. What if you don't like that entry? You want it to break out before you buy it. Okay. So you can risk this level still at $1. This is not, I'm not doing TA here. I'm talking about a broad concept. Okay. So, but let's just say that you decide to risk this key level of $1. Because, you know, maybe it breaks out, you buy the breakout, it wicks you out, because they do that, and then it goes on without you, and now you're sad you missed out because you weren't risking a key level. This isn't TA, I'm just talking about concepts. Okay, so let's say your risk is, your R, right? The amount that you risk for every trade is $100. And you decide to get in at 110 instead of 105 because you actually wait for the breakout. So you're risking this key level at $1, right? So what you're going to wind up with is 10 cents. 100 divided by 10 cents, which should be 1,000. But let me check. Because of my embarrassing moment a moment ago, divided by 10 cents is 1,000. 1,000. Okay. So look. Same chart, same risk level, different position size, same R. You can do this with any price. And I would like to, but first I want to explain something else. Okay, if you get in at 105 and you're risking 5 cents, then every 5-cent move is an R. Every 5-cent move is an R. If you get in at 110 and you're risking 10 cents, then every 10-cent move is an R. So there's kind of an exponential yield based on your entry and your risk level. So let's say the same stock, right, goes to $1.50. Nice move, man. So you got in at 105 and you're risking 5 cents, right? So minus 105, that's 45, right? Divide that by 5. I forgot how to write division here. Divide that by 5, you get 9. 9R, right? Nice. Okay. 10 cents, right? So you get in at so it goes to 150. You got in at 110. You were risking 10 cents. Oops, 40. Divided by your 10. Am I doing this right? Yeah, okay. It gives you 4R. That's not bad. This isn't a bad thing, you know? This is like more appealing, right? But the difference that you're going to experience with tighter risks, whether you're getting in here risking this or you're getting in here risking this, that's going to be win rate versus risk to reward. And that's a whole different thing. Okay. The point is, I'm not thinking about the money in these trades. I don't think about the money until after I've got my R's, you know, and even then I try to just think of it in terms of R. What's my win rate? What's my average risk reward? So the first thing that I did was to risk the same amount on every trade. And it was a very tiny amount. The next thing that I did was to narrow it down. Hey, I'm not alright with that. What in the heck just happened? I want my thingy back. Alright, one sec. Okay. I'm back. The next thing I did was narrow it down. You know, because before that, I was going long, I was going short, I was buying puts, I was buying calls, I was just all over the place, you know, trying to get the whole everything. And I mean, I had a little success, but earlier in the year I had more success, and then I got just destroyed in April, May, June, July, like I said. And so I had to narrow it down. And so I asked myself, you know, what's easiest? What's easiest, first of all, right? And I had to take stock of my situation. So easiest, like, options, okay, here's your chart, you know, and you buy the call here, but because of this volatility, it's still more expensive than when it's going up. That's not true. This isn't an options lesson, but or it's not necessarily true. Anyway, this isn't an options lesson, but basically, like I can't make chart-based stops on an options contract and have the premium reflect my actual risk. So I could play options and just use a set dollar risk, but it seemed to me like that would be more challenging. And I'm trying to ask myself, like, what can my dumbass do to become more profitable? I don't want to erase all of that. Yes, figured it out. Okay, so what's easiest? And at the time I'm trading, let's see, right? Long, short, calls, and puts, right? I was all over the place. I was trading big caps, small caps. I was all over the place, okay? So I said, okay, options are not going to work with what I'm attempting to do. Now, I am cynical and bearish, and I think that manic moves are stupid, and honestly, I'm just being real. So, like, the backside is what makes the most sense to me. But at the time, I didn't have enough capital to maintain a margin account and consistently practice. I know they say, like, anyway, they say a lot of things, okay? But I didn't have the capital to continuously practice on the backside, right? And I don't like the limitations of a margin account that's under PDT. So if I need practice and I need capital, I could not continue doing this, right? So that leaves me with going long. Going long is easiest. You have a cash account, you can buy whatever you want, sell it whenever you want. I mean, as long as you have the settled capital, right? And if you're risking 0.1% of your account on every trade, well, it's really hard to run out of settled funds. Although I did manage to do it a time or two. Okay, so big caps are going to be out of the question at that point, right? Because capital. So I started looking for small caps, you know, lower price float, I said, or lower priced stocks. I wanted stuff preferably below $20. Although if there were $20 opportunities, like they had to be even better than good. All right, so I decide that I'm gonna go long. All right, well, how many patterns are there? I thought, what long patterns do I know? What long patterns do I know? You know? And I made a list. And let's see, it was the listed day one. So that's, you know, stock puts out a PR. It trades a zillion shares in pre-market, and then it does stuff. So I had the listed day one. I had the multi-day breakout. That's a classic. I view a multi-day breakout at 52-week highs differently. I view this, so there's the third day surge. That's what Dan Millman, wow. That's what Dan Irish calls it. It's also known as an inner bar, three-man push, mid-candle breakout. Anyway, So listed day ones, multi-day breakouts. I called it a bounce day, right? That's the day a big runner comes down and then it invariably bounces. It's the number 5 on $5. It's the um, okay. It's the number 5 if you're familiar with Tim Sykes's penny stocking framework. Get it? Go. All right, so bounce day. There's recent reverse splits were working for a while. I had liquidity traps. And I'm not, this isn't going to be a TA lesson, but, okay, so listed day 1, MDBO at 52s, third day surge, bounce, reverse. Oh, the downtrend break on the daily chart. I really like those. But let's see. There's so many, right? I mean, right here, there's 8, just off the top of my head. And then I also had, not a pattern or just bullish daily or, you know, stuff like that. And so what I did is I said, okay, I'm only playing these patterns. And let's be honest, this is a lot. And there were even more than this. And what I did is I would track every single trade. So I almost don't want to let that go, but I'm going to. Okay. So track every trade. Every trade, right? By pattern. So that means you have to have criteria for your patterns. My criteria is a little bit loose, but I at least had a general concept of like, what is this happening on the daily chart? Okay, so what I learned first of all is I lose on day ones. Really quickly. Really quickly I figured that out. When I did nail these, I nailed them great, but it was too I won so infrequently that it barely made up for my losses and it was very discouraging. So, step 2 is stop trading the things that don't work. Stop trading the things that fail you. The patterns that fail you. Right? If you're trying to build your small account, if you're trying to be consistently profitable, the last thing that you want to do is waste time and energy and capital on things that aren't working for you. Leave it alone. Leave it alone. If it doesn't work, so if it doesn't work, then leave it alone. If it doesn't work, leave it alone. If it doesn't work for you, leave it alone. Find out what works for you. Or find out what doesn't work for you. Sorry, I like my handwriting. I like writing, and this is really important. Find out what doesn't work for you and don't do it. That's risk management. That's, I mean, it's not all of risk management, but it's a big part of risk management to just not do what doesn't work. And it sounds so simple, but maybe it's not. Right, so step one is survival. Step one is survival. And that's really important. Like, did I spell survival right? Okay. That's really important. So that's have an R and don't do what doesn't work. So one of the hardest parts about this is knowing, how do I know? How do I know if it doesn't work for me, right? Like I see, we'll take the, what do you call it? The bounce days first, right? The stock goes up, has a massive day. Everyone thinks it's going to go forever, and then it doesn't, and it comes right back down. Everybody's panicking, right? About 50% level, you get a nice little hold ski there, right? And then maybe there's a volume wash. It's just glorious. And then the thing holds that area overnight and then breaks red to green and does like a 70% move, right? Before it comes back down. I see this and I'm like, double bottom, holds the lows, holds the high, breaks red to green, goes 75%. I can get that trade. I can get this R. These R's. Look at all those R's. Stacking R's. Okay, but I invariably, historically, statistically, I have invariably screwed this up. And I will turn this amazing play into a loser. And all my friends and my favorite teachers, Hadi and Dom, Tim Gratani, like they all nail these. And I can see it. I can see how I could nail this. And I don't. I don't. Over 100 samples, my expectancy is 0.9. That means that I'm not winning on them. Over 100 samples. So I tried this 100 times, and I lost. I lost. You know? I didn't even break even over 100 samples. So I said, I'm gonna leave it alone. And I cheer my friends on when they see these, and I watch them because I know that there's amazing potential here. And at some point, I'll, figure it out. I'll systematize it, and I'll get better at it, and I'll give it a try again. It's a really good pattern. But when I'm trying to survive, this is not good for me. I don't do well with it. So if I'm trying to survive, like, I'm not going to do this because I'm not good at it. It's like if you were in the woods, and you knew how to, say, hunt rabbits, right? But all your friends are fishing. I'll do a Jesus fish really badly. Okay. Now I have to draw flippin' fish just to prove to myself I can do it. Okay. So you're really good at hunting rabbits, and all your friends are eating fish because they're all good at fishing, and they're all happy eating fish, right? And there's no rabbits out today, right? That doesn't mean you go fish and scare away all the fish and then everybody goes hungry. No, you just fast for the day and go find your rabbit tomorrow. Watch your friends fish, so maybe you can learn how to fish. And then when you're good at fishing, you can fish. But right now, you're not good at fishing. Don't go fishing. Wait for your rabbits and go catch your rabbits. All right. I hope that landed. So then the next thing, right, is find out what are you good at? What are you good at? And for me, I found that I'm good at multi-day breakouts. I'm actually not good at multi-day breakouts at 52s. 52s, whatever. At all-time highs, at 52-week highs. I'm not good at those. I don't know why. And maybe I'll improve. But anyway, so I'm good at multi-day breakouts. I'm good at third-day surges. I'm good at downtrend breaks. And that's it. That's all I need. There's like 3 or 4 plays a week. Easy. In the slow months in January, February, there were at least one a day. And that was when everyone was complaining that it was slow. I'm just kicking back, grabbing my downtrend breaks. Third day surges weren't working. But if you saw stocks set up and just hold and hold and hold and hold and hold. And yeah, everyone's complaining that it's slow. They're talking about how illiquid it is. This thing is just holding. You get that little perk. Breaks the downtrend. Pulls back some. And then everyone is caught off guard. That came out of nowhere. What is going on with this stock? Oh my God, is the market warming up again? It didn't actually. This was unheard of in January of 2022. But you get the point. You know, you get in here, you're risking the key level, you get 4R, you know, maybe it breaks out, but not in January 2022. Anyway, so I found out what I was good at. And multi-day breakouts, okay, so my third day surge, right? Let's just say that my third day surge, I had a win of 1, right? So my multi-day breakouts were performing 300 times better, or 300% better than third day surges. So what was I good at? Multi-day breakouts. So now if I see a multi-day breakout setting up, you know, I'm up in the morning, ready to go. You know, I've got it on my scanner. It's my top watch. I have the entire thing planned out before the market opens the next day. I'm ready to trade this multi-day breakout. You know, I've got my position size calculated. My I know basically like where I'm gonna risk. And of course, this is flexible coming in because things develop over time, and I could get, you know, tighter risk. I might have to go a little wider. I might, you know. But the thing is that this doesn't change, right? It's a multi-day breakout. So let's say we've got it. Boom. Stock puts in a zillion volume, right? Goes on a massive run, comes back down, holds. Ooh, it's so shiny. Oh, is it gonna do it, right? And then this day, right, I'm coming in to the morning. This is pre-market. And I'm expecting it to hold through pre-market. This is what I want. And then just have a little perk in the morning, and then it breaks out and goes, right? So that's what I'm expecting. But let's say that it comes down here, right? and then it starts to go back up. So this is no longer a multi-day breakout. Some jerk ruined my plan during pre-market hours, during this liquidity, right? My plan is busted. This is not a rabbit anymore. And so this can go to 1,000 for all I care. My plan is not there. I might adapt depending on market conditions and stuff, like how I'm feeling, how I've been performing, like what, I might adapt. But I am no longer considering this what I thought it was, and I am much less likely to trade it because I was already wrong once. So know what you're good at and know when something is not that thing. Know when something is not that thing. And sometimes our attachment to results will blind us and make us see things that aren't there. And that's why process is more important than profits, right? Process over profits. And another way to say this is that it's something results oriented. It might be process. That sounds a little more repetitive, and I would like to have a different system maybe. The system is more important than the results. So the long term is more important than the short term, etc., etc. And if you're only worried about profits, if you're only worried about immediate results, if you're only worried about the short term, then it's difficult to create something sustainable. So that's what that means. All right, the last thing that I'm going to say is the intraday is not as important as the daily. Or I even prefer more the intradaily. Because the daily can give you a good big picture and a great idea, but then the intradaily can, be really good too. Anyway, so let's say that you're looking at this stock. Whoops. Let's say you're looking at the stock. This is on the intraday chart, and it's on the 1 minute chart, and it's like, oh yeah, looks good, right? I'm gonna get that. Right? And so you're trading this stock, right? But let's say then you look at the daily. And this is what you've got, right? This was yesterday, and here's your little move. What do you think is going to happen? What's most likely to happen? If you say short squeeze, just stop watching this right now. It depends on a lot of factors. There's not enough information in this little line, right? But let's assume standard volume today. All of this selling off has been roughly the same amount of volume. And then this little move here, this day, is the same amount of volume, right? It's going to just continue. There hasn't been any sort of change. If you're looking at the intraday, you're seeing this. I know we just talked about first green days or first green day reversals or whatever, but this is not an example of that. This is a 1 year chart. This is not. I mean, okay, like long-term risk reward, yeah, it's there, you know, but it's just not very likely to be helpful for most day traders. So just something to consider. Look at the bigger picture here. This is more what I like to see. And actually, we can use that same daily chart, and there's like a wild difference, right? If, okay, dropping down, holding, dropping down, holding, dropping down, holding, dropping down, holding, holding, dropping down. Okay, now let's say that this is, so now we have more information, right? Let's say it's a battery play. And we just heard that Tesla is running out of batteries. Running. This is all hypothetical. Running out of batteries. And this little company is a well-known battery company, right? So you've got all of this like slow volume sell-off, right? And then today, you have this massive volume spike, and it pops up a little. So now, I'm not going to play this today. I don't care what this does today. Great, massive volume spike, perfect, beautiful, like carry on. And let's just say that it does have a nice bounce, right? So then I'm going to put it on my watch list. So this volume bar is all from this day where it has this massive bounce. Okay. So then I'm going to put it on my watch list, and I'm going to watch the intradaily, because this volume bar has just been insane. I'm looking for insane volume, right? Like this was 100,000 a day for the last year, and then it just got a zillion in one day. I'm not going to trade it that day. I'm going to watch it. And then now let's say that it sets up over time, and now I'm interested. I'd probably be interested around here, or when this downtrend breaks, or, you know, I'm looking at the daily chart. I'm looking for, this deserves its own, I'm looking for stellar setups on the daily. The example I just gave wasn't particularly stellar. I mean, with the fundamental aid of the Tesla battery play connection, whatever, that helps. The zillions of volume traded at all-time lows, that helps. If it's a low float, that helps. You know, but that daily chart wasn't stellar. How about one like this, where it goes up and it comes down, and right, this is on the daily chart, right? And then you get a volume spike, it comes down. Yeah. Right, so here you probably had a lot of volume these days. Sells off. Sell-offs usually have a lot of volume too. Volume, right? So now you've got all these bag holders from in here. That's okay. And then the volume is just lackluster this whole time. You get a volume spike in here. Let's say this day, right? You get a volume spike. Boom. Blows all these out of the water, right? So that tells me all of these guys are probably out, you know, because they had enough buying. They've held on for almost a year. They don't want to be in it anymore. They don't want to think about it. They're break even. They can save their marriage. They can, they don't have to shut down their kids' college fund, whatever. They get out break even into this push. And this push fails, and all these short sellers are like, ha ha, ha, we won. Dirty short sellers winning. Ah, take that, bulls. And then you got this intradaily chart, right? Like this. Boop, 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 boop. Nice breakout. Get a couple bucks there. You know, comes down, whoosh, holds over this previous high, right? This is all on the daily chart. So you're waiting, I'm waiting days for these setups. And then it breaks over this little level here, the intradaily breakout, which I've come to love. And then, you know, maybe it goes, maybe not. See what kind of fundamentals there are, what kind of hype it gets. Anyway, I'm going to summarize here. Here's how I became consistently profitable. In brief, I mean, this is an hour video. This process took years. All right, so one, risk the same amount on every trade. Same dollar amount on every trade. Find out what doesn't work and don't do it. Find out what doesn't work for you, for me, and don't do it. It's not worth it. Find out what does work. What does work. And do that. So simple, right? Well, how do you do that? Focus on big picture setups. Because being aware of the big picture is going to give you the most perspective. Like a fish, let's see if I can do this, doesn't know what the ocean looks like. Right, so this fish might be wandering around and he just sees like his tiny little fish foods, ocean fish foods, right? And one day he's like, there's no fish foods, right? He doesn't have perspective. You and I see that there's fish foods all over here, and he is just in his tiny little bubble. Don't be the fish in the bubble. Be the fish in the ocean. You know, be the bird. I don't know, I'm getting all philosophical and stuff, but pretty sure my girlfriend's awake and waiting patiently for me to stop yammering about stocks. So, thanks for watching. I hope that these 3 tips were helpful. Bye.